Hello, and welcome to this discussion of long-term disability insurance. Disability insurance is an often overlooked part of financial planning, but it's one of the most important protections you can build for yourself as you're working toward financial independence. Let's start with what it is. Long-term disability insurance pays a benefit in the event of a disability to replace income you lose if you're out of work due to things like sickness, an accident, injury, any of those kind of things. Why is this important? One of the main reasons, especially for young workers early in their career, is income is one of the primary strengths you have going for you as you're trying to set aside money for the future. A lot of professionals make a high income, and it's very important to protect that income, not only so that you can pay current expenses, but also so you'll have a surplus to be able to set aside savings and put money toward investments that will grow for your long-term financial independence. And disability, unfortunately, is much more common than we often think. In many ways, a disability is a bigger risk to most people than a premature death. In fact, the Council for Disability Awareness found that about a fourth of today's 20-year-olds will miss at least a year of work due to a disability before they hit Social Security age in their 60s. The term disability also can be a little misleading because we might tend to assume that means an accident or car crash or some type of injury. But again, according to the Council for Disability Awareness, injuries only account for about 12% of disability claims. Much more common reasons, according to the CDA, are musculoskeletal disorders, which account for about 28% of claims, cancer at 15%, and then other reasons like mental health or heart disease or other circulatory problems. So keep in mind that we can't fully control our health, and it's important to be able to provide income protection if a health event were to take you out of work for a long period. The goal with long-term disability insurance is to be able to replace about 60 to 80% of income all the way until you're age 65. Long-term disability insurance does have a lot of jargon in it, so let's try to break some of that down. One key term is the elimination period. That's basically a waiting time, or how long from the onset of the disability until the benefits start. A good idea is to aim for a 90-day elimination period, although you can go for a 180-day period, particularly if you're looking to save on the premium cost. One of the keys as you consider the elimination period is to make sure you have enough of an emergency reserve to cover 90 days to 180 days of living expenses. Another key term is own occupation. Another one is any occupation, and those both relate to how the policy defines disability. Own occupation is the best benefit that a policy owner can receive. And that's because in this situation, benefits are paid out if you can't do your own specific job, but you can work in another role and receive income from that. An example would be, say, a heart surgeon, a very highly skilled, highly specialized job that pays high income. If that heart surgeon has a disability and can't perform surgery, but still can teach at a medical center, be a professor, for example, that surgeon could draw that lower income and then use the own occupation benefit from the disability policy to make up the difference in income. In contrast, any occupation is much less generous, and the reason for that is this type of benefit pays out only if you basically can't work at all. So an example of that would be if that same heart surgeon has a disability and can work as an Uber driver, well, that is going to tell the policy or the insurance company this person is still able to work, so we're not going to pay out benefits. One of the reasons it's very important to look at the definition of disability. Other key terms relate to riders and cost of living adjustments. The benefit increase rider helps the disability benefit keep pace with inflation. So as a person is working and not disabled, this will, on an every so often basis, maybe every few years, will adjust the disability to keep pace with inflation. So let's say you get a policy that's going to pay $9,000 a month in benefits. Well, after a few years then, due to the benefit increase rider, the benefit may increase to $9,200 and then maybe $9,500 and so on and so forth. Then a cost of living adjustment rider takes effect when the disability happens. So if you have a prolonged disability, it would be a detriment if the policy just paid out a flat amount throughout a decade-long disability. But with a cost of living adjustment, or COLA, the benefit increases throughout the disability period. The COLA is tied to the consumer price index to measure inflation, although there usually is a cap. If the CPI, for example, shows inflation at 5 or 6%, often the cap is 3% or 4% a year. But that's still important protection that helps the benefits maintain purchasing power over time. Now let's talk about the overall cost of disability insurance. Some of the key factors are age, health history, profession and the income that goes with it, and also male versus female. In general, because females statistically tend to have more long-term disability claims, a disability policy tends to be more expensive for a woman than for a man of the same age, health history, and so forth. It's kind of interesting that that's the reverse of term life insurance, in which women tend to pay lower rates because women live longer, according to the statistics. Long-term disability insurance does come at a hefty price. It is worth it for many people, but because of the expense, it's a good idea to try to keep the total premium cost to 3% or less of income. So we used the example earlier of a surgeon. Let's say that surgeon were making $300,000 a year. That would mean that person would not want to pay more than $9,000 a year in disability premiums. And there are some key differences between employer-provided disability insurance versus a private policy you buy on your own. For example, an employer-provided policy is not portable. So if you change jobs, that policy won't go with you, and it just depends on whether your new employer offers disability insurance. In contrast, a private policy is portable. So if you move cross-country or change jobs, you still keep your policy as long as you pay the premiums. Also, if the employer pays the premium for disability insurance, the benefits are taxable, and that can be a big hit when income has already dropped due to a disability. In contrast, a private policy is non-taxable, which means you keep more of your money in your pocket, and that's very important as you're adjusting to life after a disability. Also, a private policy typically offers the ability for the true own occupation, more generous benefit policy we talked about earlier. On the other hand, an employer-provided policy may immediately be the less generous any occupation definition, or it may start at own occ for a year or two and then switch to the less generous any occ. Also important to keep in mind, the application process for long-term disability insurance is very involved, typically with a lot of financial and health questions from the underwriter. So just be prepared for a long process. Despite the expense and the administrative work of getting a disability policy, it can be one of the best protections you can have for yourself, as it protects your income stream, which is really important throughout a working career. If you found this video to be helpful, we encourage you to subscribe to our YouTube channel and share our content with others who may find it helpful. And as always, this video is intended for educational purposes only and is not meant to address specific situations. If you do have questions about your own specific situation, please contact your financial advisor.